is what we were really looking at now is a period where it's going to be a little bit touch and go with the stimulus. The economy probably doesn't come roaring out of the gate in 2021 because of the ongoing presence of the virus. But by this time next year, certainly, if not well before, we think we'll finally be at that bright light at the end of the tunnel. So if you're buying stocks today with the hope that a year or 2 years or 5 years from now, you're going to be happy you did so, we think that trade is still very much in place. But the volatility we could see is actually short term, not long term. And as we write in our 2021 outlook, that's actually pretty unusual. Usually you think you know more about the short term and you have more uncertainty about the long term, but it's really reversed here. We have a great sense that the vaccine rolling out is going to help the economy get back on sure footing, that it's going to be a broad-based recovery, and that the rally into 2021 should be more broad-based than what we saw in 2020, which is led heavily by growth.
So what exactly is the strategy then, Brian? Because this is what you do. How exactly then do you kind of move into the market or in and out of the market? How exactly do you tackle investing in this kind of environment? Do you wait for the pullbacks? If so, how much is the pullback worth before you kind of dip in? And what point do you kind of reduce positions? How exactly does that work out?
I think the big lesson of 2020 for investors is that waiting for the pullback is almost always the wrong move, because that pullback you're looking for may never come. After the initial dip we got this year in February and March, we never really got another opportunity, that good at least, for investors to put their money in. So having put your money in at the end of March, you're quite happy. You've been holding cash all year, you're less happy. We think that we're not going to see the same kind of extreme moves we think in 2021, but being in the market we think is still the best route to take. Now, where should we be? We still prefer higher quality names. So even if you're looking at value, we think financials have a nice path for 2021. We think industrials have a chance to outperform. If you're looking outside the United States, emerging markets, especially in places that have not done as well this year. So Latin America, for example, those are all plays on a more positive cyclical story for 2021 versus the very ugly story we got this year.
So, Brian, I'm right now this morning we got the kind of, update to Bank of America Merrill Lynch's Global Fund Manager Survey. On it, they say that they see cash levels going down to 4%, which triggers a sell signal on their part, kind of implying that the market is maybe a little bit overvalued at this point. They also say that some of the most crowded trades are long technology, short the U.S. dollar, and long Bitcoin. How exactly does that resonate in the kind of construct that you're dealing with as an investment strategist?
Well, those all sound pretty right to me. I think technology is a crowded trade because that's where people have, I think, rightly felt safe this year. We still think long term, with the revenues, with the operating models, with the innovation, the cash on hand to put more work into investments, we think that's still a good sector to be at. Right now, the valuation may be telling you that there's time for relative underperformance. Doesn't mean we think technology stocks are going to dip next year, but relative to the rest of the market, I don't think they do nearly as well as they did this year. Interesting about the cash levels dipping being a contrarian indicator. I think that's right. If you look at individual investor surveys, all year individual investors were bearish on the market up until really just after the election and after the news about the vaccine, when things have kind of flipped around. And we see the markets, have continued to do well, but maybe not at the same trajectory. Because really what we're seeing here is a market that has been fueled by good news and hope for 2021. When we get news about a vaccine, news about a stimulus compromise, any kind of incremental progress on that, the market tends to like it. Looks like the futures are going to be open positive this morning. But when we don't get that news, when people are focusing instead on the virus, on the ongoing health and economic toll it's taking, the market wants to pull back. And I think that's very much emblematic of what individual investors may be doing with their money as well.
All right, 10 seconds left, Brian. What's your favorite sector?
For next year, I think financials. Underperformer this year. We think maybe we get a little bit of a glide higher in longer-term interest rates next year. Not a big spike, not a big inflationary spike, but I think that sector is primed to outperform if the economy really gets going again, because it benefits from all other sectors doing well.
Shepard Smith here. Thanks for watching CNBC on YouTube.